We're going to be looking at the Great Depression, and we're going to start by looking at the Great Crash. A lot of people sometimes mistakenly make that link there. They think that the great stock market crash of 1929 caused the Great Depression. And just because there's a correlation doesn't necessarily mean there's causation. Um, there were similar things that contributed to both. They did happen. The onset of the Great Depression coincided with the stock market crash. I think the stock market crash contributed to the Great Depression and it made it worse. But many of the same factors that caused the Great Depression also caused the stock market collapse. And so it's important that we understand that there's not necessarily, this wasn't the only cause. There were many underlying causes behind the Great Depression. So our learning objectives for this section are to explain the economic factors and conditions that made the 1920s appear to be a very prosperous time in the United States. We wanted to identify the basic economic weaknesses in the economy in the 1920s and describe the effects of the crash on the economy of the United States and the world. So, we start by looking at the appearance of prosperity. Between 1922 and 1928, the U.S. gross national product, or total value of all goods and services, rose 40%. Though farmers and some other workers didn't benefit, the overall economy performed well, especially for automakers and those who made auto parts. Overall unemployment remained low, averaging around 5%, which is what they consider to be full employment. Between 1923 and 1929, union membership slowed as employers expanded welfare capitalism programs, which are, once again, benefits provided to the employees that we talked about in a previous chapter. This feeling of prosperity encouraged workers to buy new products and to enjoy leisure activities such as movies. We also had a very strong stock market during the 1920s. The stock market, where people buy stocks or shares in companies, performed very well in the 1920s, with stock values sharply increasing each month. The value of stocks traded quadrupled over 9 years. The steep rise in stock prices made people think that the market would never drop, and more ordinary Americans bought stock than ever before. The number of shares traded rose from 318 million in 1920 to over 1 billion in 1929. So over that 9-year span, literally they more than tripled the number of shares that were traded. Business leaders said that everyone could get rich from stocks. Now, you may have heard people say before that, the old cliche, that history always repeats itself. And of course, one of the main reasons why we study history is so that we can learn from it and not repeat our mistakes. Well, in the case of the stock market crash of 1929, there were many causes that were very similar to what happened in the housing market a few years ago. And in fact, another great quote I've heard, similar to the cliche that history always repeats itself, is, history may not always repeat itself, but at least it rhymes. Meaning that things may not be exactly the same, but the things will likely be similar, that they're going to be parallels. And certainly, we can find many, many parallels between the stock market crash of 1929 and the housing industry. So, a few years back, before the so-called subprime mortgage crisis, many people were buying homes and were using their homes as a source of revenue. People were taking out loans against the equity in their homes. People just seem to think that you couldn't go wrong with home ownership. And it's true that real estate as an investment generally is pretty sound, because real estate does tend to appreciate or go up in value. But what ended up happening was that the bottom fell out of the market. The market became overinflated, couldn't sustain itself, and many people kind of ignored the warning signs of the impending bubble bursting. And when it did come crashing down, it had a catastrophic effect on many people. Well, the stock market kind of did the same thing in the 1920s. People began to see stock as a means that people could invest in, and they just felt that they couldn't go wrong, that anybody could become rich investing in stocks. Um, Also, many Americans during the 1920s thought that the prosperity of the 1920s proved the triumph of American business, and public confidence in government was high. Presidents Harding and Coolidge both favored policies that helped business, and both were very popular, easily winning elections. So when Coolidge didn't run for re-election in 1928, the Republicans easily chose Herbert Hoover. Hoover had been on Harding and Coolidge's cabinets, had overseen America's food production during World War I, and had an outstanding reputation as a business leader, like administrator. Hoover's opponent was New York Governor Al Smith, an outgoing politician with a strong Brooklyn accent whose support came mostly from the cities. Smith was the first Catholic to run for president, and he faced prejudice because of his religion and because of his opposition to prohibition. Hoover easily won the election, but the race clearly demonstrated the conflicts dividing the nation in that era. While many Americans enjoyed good fortune in the 1920s, many serious problems bubbled underneath the surface. One problem in the American economy was the uneven distribution of wealth during the 1920s. The wealthiest 1% of the population's income grew 75%, but the average worker saw under a 10% gain. For most Americans, rising prices swallowed up any increase in salary. Coal miners and farmers were hit very hard, but by 1929, over 70% of U.S. families had too low of an income for a good standard of living. 4 out of every 5 families couldn't save any money during the so-called boom years. Credit allowed Americans to buy expensive goods, but by the end of the decade, many people had reached their credit limits, and purchases slowed. Warehouses became filled with goods that nobody could afford to buy. Investors were buying on margin, or buying stocks with loans from stockbrokers, intending to pay the brokers back when they sold the stock. As the market rose, brokers required less margin or investors' money for stocks and gave bigger loans to investors. Buying on margin was risky because fallen stocks left investors in debt with no money. If stocks fell, the brokers could ask for their loans back, which was called a margin call. The board of the Federal Reserve, the nation's central bank, worried about the nation's interest in stock and decided to make it harder for brokers to offer margin loans to investors. Their move was successful until money came from a new source. American corporations were willing to give brokers money for margin loans, and the buying continued to rise. The steady growth of the early 1920s gave way to outstanding gains at the end of the decade until its September 3rd, 1929 peak. So this was the high point in the stock market. September 3rd, 1929 was the highest point the stock market had ever reached, and things looked great. However, many people were beginning to see trouble as consumer purchasing fell and rumors of a collapse circulated. Once again, if I go back to the housing crisis, there was talk about the so-called housing bubble bursting, but a lot of people simply ignored it, thinking that housing prices would simply continue to go up indefinitely. So, this was going on in the stock market. And on Thursday, October 24th, 1929, some nervous investors began selling their stock and others followed, creating a huge sell-off with no buyers. Now, of course, keep in mind that stocks, much like many other items, are affected by supply and demand. So when people are wanting to sell stocks and nobody's really lined up wanting to try to buy them, that drives prices lower. And that's exactly what was happening. So stock prices began to fall because, well, quite frankly, people were afraid that stock prices were going to drop. Nobody wants to buy stocks when they're getting ready to drop. And as a result, you had many buyers unwilling to buy, and the sellers trying to sell their stocks as they began to see the value of the stocks plummet. So the stock prices plunged, triggering an even greater panic to sell. And towards the end of the day, leading bankers joined together to buy stocks to prevent further collapse, which that stopped the panic through Friday. However, the stock market would be closed down for the weekend, but the next Monday, the market sank again. And then on Black Tuesday, October 29th, it was the worst day, affecting the stocks of even solid companies. The damage was widespread and catastrophic. In a few short days, the market had dropped in value by about $16 billion, nearly one half of its pre-crash value. So looking at the effects of the crash, though some thought the market would rally, countless individual investors were ruined. Margin buyers were hit the hardest because brokers demanded that they pay back the money that they had been loaned. To repay the loans, investors were forced to sell their stocks for far less than they had paid, and some lost their entire savings, making up the difference. In the end, many investors owed huge, enormous amounts of money to their brokers with no stocks or savings left to pay their debts. The crash triggered a banking crisis, causing bank runs as frightened depositors rushed to withdraw their money, draining the bank of funds. Many banks themselves had invested directly or indirectly in the stock market by buying company stocks or lending brokers money to loan to investors on margin. When the investors couldn't repay the margins, banks lost money too. These failures drove many banks out of business. The crash crushed businesses because banks couldn't lend money. Consumers also cut back their spending on everything but essentials, and companies were forced to lay off workers when demand decreased. Unemployed workers had even less money to make purchases, and the cycle continued. In the year after the crash, American wages dropped by $4 billion, and nearly 3 million people had lost their jobs. The fragile economies of Europe were struggling from World War I. They had borrowed a great deal of money from American banks, and the banks now wanted that money back. With the U.S. buying power down, foreign businesses were less able to export their products and were forced to fire workers. Governments tried to protect themselves by passing high tariffs, making foreign goods expensive. The decline in world trade in the 1930s created misery around the world and contributed to the nation's slide into the Great Depression.